Well, hello traders. Let's do a quick run through of the agenda through the class, what you can expect as far as the agenda goes. We'll talk about futures basics, why you're trading them, how to trade them, understanding margin requirements, time frames, micro futures, which is a specialty of mine, and of course going through some successful futures trading examples. So we're going to hit all the buttons, and we'll start out with just a very basic understanding. But first, just a quick introduction of who we are here at Simpler. Obviously, y'all all know of John Carter, founder of Simpler Trading in 1999. Instead of wanting to talk to his goldfish while trading alone, he launched Trade the Markets to create a place to post his trading ideas, and that ultimately grew to what is Simpler Trading today. And our mission is to build and transform lives through trading, create one of the most enduring sources of quality, tried, and applied content in the industry to help our clients be successful too. Long story short, I want to help shorten your learning curve, help you understand all the ideas as best as possible. So we offer a lot. We can basically cover all the different aspects of any type of trading, whether it's indexes, commodities, theory, technical analysis. We can cover it all. We have an amazing team. Here's a nice shot of some of our traders, and we can cover all the things. So even quantitative analysis now, on top of stocks, micro futures, day trading options, all that kind of stuff. So why trade alone, right? So for me, having John in my life has been a blessing. He's been a mentor to me in my trading, and he really helped me understand some key things before I would jump right back into trading futures contracts. And so that's just one example of how John has helped me in the past. But I couldn't even begin to tell you all the different things that I've learned over years of him being able to answer any questions I have along with my trading. So what are futures? Futures are contracts that allow you to trade commodities and indexes: oil, wheat, gold, silver, even the S&P 500. These contracts are an agreement to buy or sell the underlying commodity or other assets at a specific price at a future date. So what are commodities and indexes then? All right, well, the commodities are the S&P 500. We call this the ES in the futures world. And then, of course, commodities are basic goods like oil, corn, gold, and natural gas. By trading futures, you're trading commodities or indexes. So you are straight to the source as far as the contract. You're opening and closing contracts to buy or sell based on the price and what you expect it to do over a given amount of time. All right, so why are we trading futures? Like, why not just try stocks and options? Well, the futures market is more like of an opportunity, not for just profit, but to hedge other positions. So if you're long stock, you could be short the indexes in some capacity. An airline might want to buy futures contracts in oil to lock in today's oil price if they think that oil's price is going to rise. We've already seen that twice this year. An oil company might want to sell futures contracts to secure demand to sell their product in the future. We've seen this before, almost twice. So there's a few different examples for opportunity as to why some big players would want to trade in the futures market. As far as a retail trader, you're using this as a way to have more exposure outside of stocks and or options. So I do a little bit of everything. I'm all about options. I'm all about futures, even futures on options on futures rather, and stocks. I would even branch out and say crypto and real estate. But let's focus on what you can do with futures contracts. Well, you can use them as a hedge, or you can, you can use something where it's like, well, if you have a long position across the indexes, you could put on some type of speculative move on another commodity, whether that be gold or silver, or any of the other precious commodities, coffee, wheat. The list goes on, and you can do certainly different things with a futures contracts. Where if you were trading options or stock, you're limited by just those moves alone. And so it gets kind of like, well, all right, we can trade futures. Now, what exactly are we trading? Well, you're trading the value of what it's placed on during that time. So, commodities like gold are measured in ounces, bond notes, currency, indexes, volatility. You can trade it all, right? So, specifically, what I like to do is not go too deep into detail on all this stuff just yet, because you'll see as we unpack some more ideas that there's various contracts, there's micro futures, and there's other reasons why you would want to trade futures instead of stocks or options. So we'll get into that. So here's some various contract sizes. The micro futures, which is what I'm a specialty trader in, are basically 1/10 the size of an E-mini contract or any of the regular futures contracts. Okay, and you can see this here in your slide. So, whenever you have a full size multiplier on the S&Ps of, let's say, $25, that's significantly lower, whereas a micro would be a $5 multiplier. So the more you trade micro futures, you'll understand this. And it's always nice to, get your feet wet in either a paper trading account just to kind of see the personality before you want to start, exposing your own independent cash. But they are significantly lower, which means lower risk of losing an absorbent amount of money that maybe you shouldn't have. Right? There's all sorts of different advantages as to why you would want to trade micro futures. So another reason to trade futures is with options. The market's going up or down, but you still have a thing called the Greeks. So your delta, your theta, your vega, and all that kind of stuff. With futures, you're simply going long or short. And that's what I mean. It's very straight to the source, binary in action, and you know what you're getting into and what you can get out of as well. So, it's not complex. It's very straightforward. You're buying or selling. Makes it easy on everybody. But really, let's get into why. Like, really, why would I trade futures? So, if you want to trade oil, then you could, buy or sell crude /CL, right? If you wanted to trade the indexes, buying or selling the NASDAQ, you would think that the price is just generally going to be lower or higher. You can short or you can buy the NASDAQ futures /NQ. For micro futures, that would be /MNQ. All the micros start with an M. Now, that's very easy, right? Futures, binary in nature, straight to the source, no options involved, fairly easy. And this is a nice little infographic that you'll have, and you can save this if you want to. This basically gives you all the differences between options and futures. And so futures are just very straightforward. Options just have more complexity to them due to the Greeks and due to time passing effects. Okay. Options, you can exercise your options to buy shares of stock. With futures, you're buying and selling the future contract, or you can choose to roll them into a future expiration. So you can do a little bit of both with options as well, but there is less complexity to the entire situation. It's simplified by just trading the futures. So how do we trade futures? Okay, we know we can buy and sell. Let me give you my 5 key components. All right, so getting started, you got to set up an account. You've got to make sure that you're going to be able to have intraday margin. Remember that, intraday margin. Okay. And with micro futures, you can have, a couple $1,000s in the bank and easily trade up to 3 micro futures contracts as long as you have the minimal margin requirement. And that's, very easy to do. Everybody's competitive these days, so it shouldn't be a struggle at all to be able to open up and have at least some type of intraday margin for trading in a small account, trading micro futures. So you get this account going, you choose the right broker, you explore different margins. You'll probably get, in a small account, your first basic, you'll get very minimal margin. And we talk about this a little bit later as well. But as you do your research, just make sure that, you don't have to have an absorbent amount of money to have just some very simple intraday margin. That's the number one requirement, is just make sure that your brokerage understands that they're not, taking advantage of you. Some of my favorites are Tastyworks. That's a great brokerage to have, and they're amazing with intraday margin. And honestly, I've never had an issue. So that's that. Like, it's just getting it started, understanding how you have to fund your account, and then it's like, well, how do we find the futures? Well, the way you find them is just / ES or / MES, or for gold / GC. And in your Thinkorswim platform, if you use Thinkorswim, the drop down futures menu will give you all the different futures that exist. And it's a whole list of them, because you have the currency futures, you have commodity futures, you have the index futures, then you have the micro futures, then you have cryptocurrency futures, and the list seems to be growing. All right. So each futures market has its own specific ticker symbol that's followed by symbols for the contract month and the year. So, like, sometimes you'll see, if you're trading the S&Ps in March, it'll be ESH2. ES, the underlying futures contract for the S&P, and the H is the expiration for the month of March. The 2 stands for the year 2022. Okay? So all of your futures contracts will be ESH2, ESK2, ESQ2, but that'll always be in that format. And everything exercises equally across that. So same thing for crude. It'd be CLJ2 if you were doing the oil April 2022 contracts. Okay, so it's these are just simple nuances worth understanding, because once you learn about it, it becomes a little bit more natural, and you don't have to worry about memorizing any of this stuff. And then this right here, we made this slide to just kind of talk about what you can expect, what they look like. These don't have the / on there, but that's just already implied that every futures contract on almost every platform out there starts with a /. Okay, but these are the most popular futures symbols. My favorites are the micro NASDAQ and the micro S&P, but we'll touch more on the micro futures a little bit later. So again, with these components, these are the 5 most important things to understand: the trading hours, the tick size, the contract value, margin, and leverage. I know that seems like a long list. It's all kind of part of one big thing. So let me show you this. This right here is the time. So the first key component is time, the trading hours involved. So obviously throughout the entire market morning, those will start up at, the futures have already been trading since Sunday afternoon at 6 p.m. And 5 p.m. Central. So 6 Eastern, 5 p.m. Central. And that's Sunday afternoon. Market continues to stay open. And what you have is, every day futures contracts are open Monday through Friday, but they do take a break every day from 4 to 5. So it's kind of like a daily break. They'll trade all the way into 3 o'clock. Then you have the 3 to 3:30, and then they take a break from 4 to 5. So this is a good chart outlining that here. So futures move in price increments referred to as points and ticks. A point is the smallest price increment that can occur on the left side of the decimal. For example, if the S&P changes from 4379 to 4380, that is a 1 point change. A tick is the smallest increment that can occur on the right side of the decimal. A point is composed of ticks, right? The value of each tick varies by the futures contracts. For example, S&P has a tick size of 0.25. It moves in ticks of 0.25, right? So it takes 4 ticks to make 1 point in the S&P, all right? Because 25 goes into 100 4 times, therefore it takes 4 ticks to move 1 point on the S&P. Same thing for gold, except we're making that decimal point 0.10. So 10 times 10 equals 100. So it takes 10 ticks to move 1 point on gold. And each individual contract has its own tick and point value. But if you know the top three, if you know the S&Ps, if you know the NASDAQ, and if you know something like gold or maybe crude, then the rest will become more like muscle memory. You'll just kind of see the point and you'll go, okay, well, that's going to trade at a 0.25 or something like that. So I always say pick your 3 favorite futures contracts and trade those for 6 months. Right? Whenever you're ready to dabble into something new, obviously that's just a new chapter in your trading, and you've got to have a good reason as to why you're jumping into something else. Sometimes it's curiosity. Sometimes it's, well, I'm not growing too much, trading gold. I'm going to try to trade oil, which is actually a common thing. So let's talk about contract size. So in gold, you have a contract unit of 100 troy ounces. And, gold contracts it's interesting because gold is starting to move a lot more coming out of 2020 and 2021. And so now I'm kind of focused more on how many contracts should I trade for gold? Well, I still say keep it at 3 if you're trading, smaller contract sizes like the micro futures. I'm thinking that for contract size, as far as like being delivered gold, you're not going to be delivered gold. But if you want to, you could certainly figure out a way, to be appointed future oil futures. And I make a joking example of whenever oil went negative $40. The joke was you could have just taken delivery of that and put it in your swimming pool, and they would have paid you to do it, right? So there's all sorts of different caveats around trading, but I never expect to be, expecting a bushel of corn on the front porch or having, my troy ounces of gold that I was buying and selling contracts of to be delivered. You will probably never have anything physically delivered unless you're in a giant conundrum with a lot of contracts on oil or some type of outlier. But there's a very small probability of you being assigned an actual commodity. Okay? So contract value, I don't want to I don't think it's well served for me to go through this with you, but contract value is known as contract notional value. It's the financial expression of the contract unit and the current price of a given futures contract. So, the contract really is like, hey, oil's trading at $95. Contract unit is 1,000 barrels. The contract value would be $95,000, right, for that entire situation. And then with the S&P, because then you go, all right, well, we're trading pretty large values here. That this starts to make sense as to why you would be expected to put up enough margin, because we're talking about pretty large sums of money here, especially whenever you're trading crude. So we'll get back to margin a little bit later, but it's important to understand that, this is not small change. It is small change if you're trading micro futures. But in these regular contracts, it mounts up to, you'll need to have some margin in your account. So that's what takes us here. Futures contracts require margin, which is buying power. Your brokerage platform lends you, on top of the money you put into your account, more money. Trading on margin gives traders leverage to trade more than their cash can afford. Be cautious with margin. You can lose more money than you put into your account and be liable to pay that money back to your broker. So, it does come with risks, but anytime you're trading, just understand that there's always some type of inherent risk, and that'll smooth things out for you a little bit more. So far we've talked about trading hours, tick size, contract value, and margin and leverage. Margin and leverage, we have a little bit more to go on that. Well, again, let's just discuss what is margin, right? Understanding that in futures contracts, it's just borrowed money, right? Here at Simpler, what we try to do is we try to take the most complicated things and just simplify it for you. It's borrowed money, right? So you're trading with borrowed money. It sounds worse than what it is, because if you're responsible with it and you don't over leverage your account, well, then it can also be a great automobile for making more money. A good vehicle that'll allow you the freedom to be able to make more money. Margin is a leverage that can enhance returns, basically. Okay, but at the same time, it can exacerbate losses. So it's a double-edged sword, but you can do it. It's always been like this. This is nothing special. This was not a new development for them to take more money from you. This has always been like this, and frankly, it's a great function to be able to try and make more money in the futures market. It allows you to use more capital. So it's actually a really good thing. I know it seems kind of scary, but it's not. It's a good thing. So there are different types of margin. There's maintenance calls, that's the bad ones, where it's like, hey, we're going to drop you a line in your email and say you were over leveraged. We'll need you to maintain this account by depositing more money to coverage the margin we allowed you to trade with. There's day margin, there's initial margin, and the margin levels are set by the CMA. But brokers may require additional funds because that's how they differ a little bit. Day margin is how much you can trade for the intraday. Initial margin is the amount of funds required to initiate a futures position and holding it past the overnight position, right, or past the close. So there's different types of margin. If you're starting a small account, you'll probably just have day margin, and you'll probably only be able to trade micro futures, and that would be anywhere from 2,000 up, and then you'll get kind of a better feel for that. I always say, because I'm a micro futures trader, start out with a small account and just trade the micro futures. Trade like 3 contracts on the S&Ps, so 3 MES or 3 of the MNQ, and kind of see how it goes from there. That's starting small, really. So let's talk about the big scary thing, and then we'll move past it. It's called a margin call. It's your broker letting you know that more money needs to be deposited into your account to maintain your levels. All right. If you cannot meet the margin call, you can reduce your position, and you can basically have to give up. And so in conclusion, what you're doing is you're adjusting your position to make sure that you have enough funds, or your net liquidating value is high enough for them to not either eliminate your position, or reduce your position, so that you can meet that market close funding amount, right? So you need to have, by the end of the day, enough money in your account to where they will not liquidate your position, or give you some type of nasty gram. They'll just say, hey, we have to liquidate your position because you're over leveraged, or you only get such amount of intraday margin for you to take advantage of. So there's a few things there to understand. If I was explaining this to a third grader, I'd say, hey, by the end of the day, you're gonna need to have more money in your account, okay? Because you may just have intraday margin, and you can hold on to your positions if you want to, still with intraday margin, as long as the margin call does not affect you. And that just comes down to how much free capital you have in your account at the end of the day. So, margins and market movement. Increased volatility may result in higher margin requirements. In other words, you'll have to put up more money or have a higher net liquidating value to trade futures contracts. So you may also check with your broker in volatile markets to make sure you know your current margin, because it can change, and whenever it does change, it can be, they'll let you know. These are some of the, like I mentioned earlier, I mentioned Tastyworks margin information, and you can click on any of these links. It'll take you to it to understand what their margin requirement is. So pretty easy there. We've made it pretty straightforward for you. Here's a good little infographic on intraday margin. So, sometimes intraday margin will be as much money as you have as your net liquidating value. So, like, here's a good example. So, you have initial margin of 13.20 on one contract, let's say. Throughout the day, let's say you have more money in your account, you can start risking more. This is a nice infographic for you to follow along, especially if you're trading S&P and micro S&P futures. Initial margin, also known as overnight or exchange margin, is the amount of funds required to initiate a futures position and hold it past the close, aka, again, the overnight position. Time frames. I'm typically staying on 3 smaller time frames, and I use one larger time frame for context. In other words, I'll look at the 1, the 5, and the 15, and for context, I'll look at the 30-minute or the hour, just to kind of get an idea of where was the market 8 to 10 hours ago, right? And so on this chart, you can kind of see this here. This is a 1, 5, and 15. And so if I look at this, it gives me, all the way from the AM. If I look at this 5-minute, it gives me all the way from maybe 7 AM, 6, 7 AM. From here, you can see it's a 1-minute chart. And so what I would look for is, these 3 time frames, and I can give you a whole summary as to how I see the markets. Okay, so we'll do that. And around the clock, futures contracts are always trading, except for Friday afternoons and Saturday. But they do start up on Sundays, like we discussed. And there's a wealth of knowledge here, multiple slides you can access to get this, to help memorize this. But the 1 hour that futures markets are closed, like I said earlier, are between 4 and 5 Central. The week for futures, therefore, starts at 5 p.m. Central on Sunday and ends at 4 p.m. on Friday. So it's a Sunday to Friday, 5 p.m. Sunday, ending on 4 p.m. Friday. Okay? Best times to trade. I think this comes down to personality. I think a lot of traders want to kind of just trade the mornings and the afternoons, and I think those are probably the best times, really. So time ranges are, early in the morning to last trade in the afternoon. Not all hours are the same. The middle of the day seems to be slower and choppier in some cases. And the morning seems to be, more direction, more volatility, which is good, especially for any type of trader that loves to do the smaller time frame type trading. You just need to find a time that works for you and a frame that works for you. Do you like to be in and out of your trades in 15 or 30 minutes? Do you like to stay within a certain lower time range, like 10 or 15? So I like the morning sessions because everything's fresh. The market structure seems to be a little bit more clear, and these are some other reasons why I connect with the morning session a little bit more than the afternoon. So I like the morning. I'm a morning person. You know, for all the reasons on this slide, those are why I choose the morning sessions. The afternoon is great. It's also the most liquid part of the session, so anywhere between 1 and 3 central, a lot of traders will just trade the close from 2 o'clock to 3. Institutional and professional traders return from lunch and drive volume up, so we know anything after about 12:30 to 1, you're going to start seeing something unique, something different. Big money balances their position in the last 15 to 20 minutes of every session, so it's very tricky to trade. Just something to look out for. It doesn't make it impossible. It just means look out for things. There are small nuances that seem very small in the trading world, but can make a huge difference if you know what you're walking into. In other words, trading the last 15 to 20 minutes, understanding why things are different, not just that they are. So FOMC meetings, lots of head fakes can happen, a lot of knee-jerk reactions. So we always talk about keeping tight stops, and there's a reason for that. But we also need to know that this can also be adjusted, and you can be looser on your stops for various reasons, which we'll get into later. So the evening session, this is after everything's closed. Let's just say you're in Central Time Zone. Um, Boom, it's 5 o'clock. Options or futures have opened, everything's good, and there's just not enough movement or volume in those evening sessions. So that's more of like a chance to trade the overnight. It's not so much an active way to be trading. You can if the market is super, super volatile, but it's more about like, hey, you can trade them. It's just more about maybe starting a pilot position or just for observation. So futures allow you to trade a world of commodities and indexes and even foreign currencies. Futures are not all equal, right? We all know the tick and the price movement is way different. Let's cover a few major futures markets. Obviously, the indexes here, the S&P, the Nasdaq, the Dow Jones, and the Russell 2000. I like trading the Russell 2000, nice small caps. On days where it just doesn't feel right to trade the Nasdaq or the S&P, and that's rare and few, far between. But sometimes I find myself just trading the Russell if I want less risk and I want to trade a smaller contract. All right, so typically all these will have lower margin requirements, especially for micro futures, which are 1/10 the size, which is what we just finished talking about. And here's another nice infographic of the S&P ES regular futures contracts. These are called the E-minis. So E-minis, just to spare you the confusion, the E-minis are the regular contracts. Those are the big ones, E-minis. The micros are the smaller ones. So you have the E-minis, even though the name doesn't suggest that they're small. And then you have the micros, which are much smaller, and those are 1/10 the size of the regular E-minis. The NASDAQ, same thing. High liquidity again, just like the S&P, heavy tech exposure, Amazon, Facebook, Alphabet, Apple. Okay, point tick values down there as well. Dow Jones, I don't trade a whole lot of the Dow. I just haven't. No particular reason. I think just as a trader, you gravitate more towards something else, and it is what it is. So, and then you have your commodities like crude, metal, grains, and these are very interesting right now, and will continue to be very interesting as far as movements goes. I can't imagine not trading or not wanting to trade commodities like raw materials like wheat, coffee, or cocoa or anything like that. It's very fun. A lot of this is very, very enjoyable. This is a fun thing to do, because supply and demand. We've had a few of other issues in the past few years with shipments and trade. All sorts of different reasons for disruptions, and sanctions. So commodities are very interesting, and futures the way to go. So crude oil, same thing here. A nice infographic to give you an idea of how that trades. $1,000 per point. Tick value is $10. So it can be very profitable. Currency and treasury yields. You have the Aussie dollar, and you have a few different examples here as well. Canadian euro, 2, 3, 5, 7, and 10-year treasury notes. You can trade futures on all this stuff. Okay, long versus short, pretty straightforward, but we wanted to put this in here just to kind of give you an idea. Some people are just so new that they don't understand what going short and going long means in the futures world, but pretty straightforward. If you're short, you're bearish, you're taking a bearish stance. If you're long, you're buying the market, you're thinking assets will increase in price over time, so you'll take a bullish stance. So from there, it's like, okay, well, if you want to go long, you look for a bullish setup. Here's 6 contracts that I took on a 45 point move higher. This was a bullish setup for many reasons. This is a 5-minute chart where I had a lot of compression on price within the squeeze. Red started to become green and yellow. We were holding a 5-minute reversion to the mean pretty well up to this point right here, and that's when it stopped. But I caught the majority of this move where I could go, all right, well, I just nailed 45 points from here to here on the reverse, and it worked out solid. It was a solid trade. I stayed in it for a little bit longer, just to see if I could, and it continued to rally. It turns out I got out of this position too fast. Sometimes that happens. So here's a bearish setup where you have a little bit more of red on the 10x bars, a squeeze. So I just kind of stepped in and sold the market, but this was way too long of a trade. About 35, 40 minutes into the trade, I was profitable, but only on 3 contracts for $132. So you can either, build into your contract size, which, in the previous example, I basically had, 6 contracts, whereas I was building, 2 and 2 and 2. I was able to profit from it pretty well. In this one, I just kept it at 3 because I had a low confidence rate, right? It was very choppy. So I kept my position small and still took some money off the table. So micro futures, again, we've said this before, they're 1/10 the size of the E-minis. Low capital requirement, great for small accounts. Risk little money to participate in market moves, and a good way of getting started trading with a small account. I always say if you're a good futures trader, you're probably an excellent options trader because it all comes down to discipline and risk. So the comparison chart here, this is probably the easiest one out of the entire presentation to follow. You have a regular S&P contract on a point would be $50. S&P micro would only be a $5, and then that translates, obviously to 1/10 the size of the E-minis, just to knock out any more confusion that you might have. So one thing about this is you go, all right, Jack, well, we have, a small slice of an index that's liquid. You could try to trade the S&Ps in the micro form before you move to the E-minis. And with a contract ratio of 1 to 10, this gives you more flexibility for getting in and out of contracts, getting out of positions, managing positions, maybe trading faster and taking the small profits just to kind of get an idea for what it's like to trade them. And it's very easy, right? Same thing here. You'll have times and dates where the opening and the closing. You can see some margin examples here. Initial margin 1188, and this is a great example actually. So everything's getting easier whenever you're trading micro futures. The S&P has lower margin than the Nasdaq. You can see that here. So, like I said, I think it's nice to start out with about 2,000 to start trading micro futures, and if you get intraday margin, obviously you can trade multiple contracts here. So micros in action. A couple things here. One of my things that I like to do is I like to be in and out of trades pretty quick. And on a fast, super volatile day, I can have as up to 15 or 20 trades, um, and I can break my own personal record. My own personal record for this particular day was $1,300 profits in a small account. And later on, I would actually this year I had one $2,000 day. So it's a lot of trading very fast, but once you get up to speed and start to break through any type of challenges or any things you have, you can trade a lot more if you want to. You don't necessarily have to, but the other thing too is none of these trades on this example have parentheses around them. So I had consistent winners. So not only am I profitable, but I'm consistent. And that's important, right? So successful futures trading comes down to discipline and knowing where you stand in the environment. Like you're not trading too much, you're not over positioning. You need to understand that futures move a lot. Supply and demand causes futures to change price almost constantly, right? And the market is always in constant auction. So very easy to get mixed up in the emotion of trading. So just know as a futures trader, your job is to not over position and really to keep yourself accountable. So you can see this day particularly was super choppy, right? This actually goes back. This is a daily time frame that goes back and talks about or shows the implied volatility from the fall of 2021 into what has turned into a little bit more of a disruptive head and shoulders pattern going into 2022. So the volatility is here. That's a good thing, but it also can be a very challenging environment to trade in. Stop losses are important. This is the biggest part of trading futures. Stop losses, it's basically an order that automatically closes out a losing position. Okay, a stop loss prevents you from blowing up an entire account, helps you calculate the risk before entering the trade, and every single trade that you enter should have a stop loss. Now, it's up to you to find out what your sweet spot is. I'm more of a loose stop loss type trader, so I try to play outside of the range, but it also means if I'm wrong, then I take on a little bit more risk and a little bit more of a loss. But if I'm right, and a lot of the time I am, I let the stops that are around me get hit, but not my stop loss. So in this market, we always like to say that no stop goes untouched. So I try to keep my stop losses away from where I think the stops actually are. So here's an example for my strategy 1, 2, and 5 minute charts. On this one right here, this is just a very small time frame because I wanted to take a look at what the 10x bars, the red, yellow, and green bars here, were telling me. So I look at context clues, I look for outlier moves. Like I'm typically coming in here and buying something down here at the third ATR or selling it up here at the third ATR, or if it's holding its reversion to the mean, I'll buy it here because that makes sense. There's also all sorts of different things you want to do on different time frames as well. So my favorite futures setup is bullish conditions, an extension that is not come up to the 1272. In other words, we have a green market, but buying the 5 minute reversion to the mean with complementary VWAP and support from initial balance charts. What that means is where's the volume weighted average price? Where does the market want to go because there's liquidity there? So that's where we typically focus on for key levels of support and resistance. And then again, where do I want to risk? Do I want to risk very little? Do I want to have a very tight stop and just play this thing directional and risk the $200? Or am I going to be a little bit more conservative, keep my stop wide and my target a little bit more conservative? These are all things to consider whenever you're trading futures contracts. So it's very interesting. Like in this trade example right here, this was $260 in 12 minutes, and I had good reason to be, long this market from 4,097, and exit point was only 13 points away. But turns out on this particular day, it would keep going and going and going. So I was out in 12 minutes and I took $260 off the table, but I could have kept it going. And had I did, it probably would have been double the profits. I remember that day specifically, but it was also a tough market to trade, and I was happy to take the money. So there's all sorts of different examples, and I feel like that covers futures to a T. As far as for a beginner course goes, those are all the details. You have the slides, you have access to them. Feel free to just thumb through, and you really only learn this stuff best by trading. So I encourage you to trade and get a feel for all this kind of stuff. And remember, futures allow you for a more diverse portfolio. They allow you to learn a little bit more about how you trade as well. Knowing the futures contracts is paramount. Knowing how to choose contract size that works for you is important. So, net liquidating value, how much money do you have in your account to trade, and how much do you want to risk all at one time. So manage your own risk properly by studying margins and sizing appropriately, getting started, and refine your strategy along the way. So in other words, trade. That's the best way for you to get exposure and understanding of the markets. Okay?